I just ordered the bankruptcy Happy Meal at 3 a.m. and when you order this Happy Meal, the rumor is that the CRA breaks into your house and absolutely messes you up. Hello? Guys, the CRA is literally outside my house.
A message from the Government of Canada.
Hello guys, it's your boy
Box and with another video. Today we're going to talk about liabilities. Liabilities come into existence when the company enters into an obligation. Liabilities are settled over time through the transfer of economic benefits, including money, goods, or services. Or simply put, a liability is what you owe.
Let's get started.
The most common liability is accounts payable. An accounts payable is an account that shows money you owe. Like the accounts receivable in the previous video, accounts payable is a waiting area for your expenses until the money actually comes out of your bank account. This waiting area exists because invoices usually have terms in them that dictate the time you have to pay your bill. The most common is called net 30, which means the payment is expected within 30 days, since people will pay as late as possible to maintain positive cash flow. That is, money is coming in faster than going out, because if you don't, you run out of money. And if you run out of money, your company is which is why you should do the same. The accounting is nice and easy. When an expense is incurred, you debit the expense account and credit the accounts payable account. Then when you actually pay the bill, you debit the accounts payable and credit cash. Accrued liabilities exist because accounting uses what is called an accrual basis, meaning that expenses are recorded when they are incurred, not when they are paid. Accrued liabilities is similar to accounts payable in that it represents an amount owed. The difference though is that accounts payable is normally used for vendor invoices that you pay in the normal course of business, when accrued expenses are for everything else. Here are some examples. You send a purchase order out but haven't been invoiced by the vendor? Accrue. Do you have a warranty for a product that hasn't yet expired? Accrue. You obtain services first but don't get billed till after the month? Accrue. Accrue.
These nuts, nigga.
As mentioned, accrued liabilities is a very broad category, so I'll just give you two common examples. First is accrued wages. Let's say that your company is open on weekdays and pays bi-weekly. So if 4 days were in month number 1 and the remaining 6 days were in month number 2, then we will need to accrue that 4 days of wages that was incurred but not actually paid out yet. If your wages for the pay period comes out to a very generous
$1,000,
then we will allocate the wages pro rata, that is, in proportion, by taking our total wages for the 10-day period, dividing it by 10 to get the wages per day, and then multiplying it by 4 to get the wages for the 4 days in the previous month. The journal entry that you'll have to do is a debit for $400 to wage expense, then a credit for $400 to accrued wages. When the wages actually get paid, you then reverse the credit with a $400 debit to accrued wages, a $600 debit to wage expense for the wages that were in month 2 and so weren't actually accrued.
Okay, so we'll begin a count of 10 on the right leg. 1, 2.
Another example is a warranty. If you sell a product that includes a quality guarantee, that's a potential liability that we will have to accrue. Normally, these warranty liabilities are subject to management's estimation based on, for the most part, historical information. If given management's experience, 2% of products require the use of the warranty, then a provision will be made to reflect the historical data. If you sell a chair for $100, you will do the usual debit to cash and credit to revenue, but we will also add a warranty expense using the 2% as established by our policy. That means that $2 will be debited as a warranty expense and an equal credit will go to warranty liability. If the customer somehow manages to break that chair, and needs to use the warranty and it ends up costing you $20, you will debit the warranty liability for $20 and credit cash for the same amount. But obviously your products will never break. So what happens when the warranty period ends? If the period is for 1 year, then you simply reverse the accrual by debiting the warranty liability and crediting the warranty expense. This can be hard for some companies to do for every single product service they sell, so what can happen is that management estimates a monthly or annual warranty amount and accrues that. They will chip away at the warranty accrual throughout the period and top it up once the period ends. Debt is probably the first thing you think about when you hear the word liability. Any money borrowed, whether a loan, a mortgage, or anything else, is generally considered debt. Today I'm going to provide an example of a normal mortgage. Let's say you've freshly arrived in Vancouver and are looking for an apartment. 1 bedroom, 1 bathroom, nothing crazy. So a nice, cool, humble mortgage. $1 billion! And at a great annual interest rate of 5% over 5 years, well, I think I would just give up. The most common ways that loans are paid off are with two methods, blended and non-blended payments. Non-blended payments consist of a fixed principal payment and a variable total payment for every period. Using our 5% interest with a fixed principal payment of $10,000, we see that the principal amount goes down by $10,000 every time, with interest payments being calculated as 5% divided by 12, as loan payments are monthly, times the opening principal balance. Blended payments have a variable principal payment but a fixed total payment. This works by first setting a fixed total payment. In this example, let's do $14,000. We will figure out the principal payments by first calculating the interest by doing 5% over 12 times 1 million, again to get $4,166.67. With that monthly interest, we deduct that amount from the total payment. So now we reduce the principal by $9,833.33. Blended payments tend to have larger interest payments at the beginning since most of the payment goes towards interest, which is why blended payments tend to have overall higher interest costs compared to non-blended payments. The benefit of blended payments is the fixed monthly payment, which gives predictability for cash flow purposes. The inverse is true for non-blended loan payments. When first receiving the money, you would debit cash for $1 million and credit a liability account that we will call, let's say, mortgage. When it comes time to pay for your loan, you will credit cash for the total payment amount and debit the mortgage account for the principal portion only, and expense the interest portion to an interest expense account. So there you go, 3 examples of what liabilities are: accounts payable, accrued liabilities, and debt. Now, see you next time when I explain the long-awaited
Income statement.
peace.